lending, give me some flashbacks of what happened then. And I know we have the topics up here on the board, and I'll kind of give sort of what's happening in the markets right now, and then lead into some product changes and some expectation setting on how your deals are going to get done moving forward for this kind of temporary window that we're in. And what I want to start with is the topic of forbearance, okay? Because I think the most important thing on this call is one of them is understanding the product changes and some of the things that aren't available anymore, and some of the changes that are going to affect potential consumers we work with for the time being. But just as important is understanding why those changes happen. So you've heard the term forbearance, and there's a lot of that going on in the news right now. And to be clear, a forbearance is not forgiveness, okay? So forbearance is a mortgage servicer saying, Liz, you don't have to make your payments for 3 months because we know that you're in a job that you might be losing hours because you can't work from home or whatever the situation is. So we're just going to give you kind of a freebie for 3 months, and then we're going to make you pay it back later. So one of the most important things to understand is it's not forgiveness. And if someone tells you you can forbear those mortgage payments for a certain period of time, they are going to make that person pay them back. The interesting part, and the part that's hard to navigate, is every loan servicer is going to have different guidelines on this. So whether you're Chase Bank, Wells Fargo, Bank of America, whoever, they're all going to make their own guidelines on what they're going to allow for forbearance and what those guidelines are going to be. So we've already heard from some of these guys that they're going to allow 90 days. I think some are starting to say they may allow 6 months. But on some of these, they're going to make them pay back those payments all at once. So imagine for a second somebody who's having trouble making their mortgage payment. Servicer says you don't have to make payments for 6 months, but then at the end of 6 months, you're going to make all 6 payments at once. You can sort of visualize that that's not a good situation for a lot of these people and could create problems in our industry. So the forbearance topic is sensitive, and one of the reasons it is they're basing it off the honor system, is what the Federal Housing Finance Agency is saying. And that's sort of the FHFA is essentially sort of the federally backed entity at the very top of the chain, right above Fannie and Freddie and FHA, that kind of sets certain regulations. And their director about a week ago on CNBC said, we're going to allow forbearance, and we want these servicers to grasp onto this topic and really help the American public, which makes perfect sense, right? But they're going to do it off the honor system, meaning that if somebody were to call in and not losing their job, can make their mortgage payments, they can technically apply for a forbearance, and the way that they're communicating it is they're just going to allow that to happen. Now, we don't know that for sure. We don't know when all these banks have their guidelines. They might look deeper into each person's situation to see if they're going to allow it. But then that gets tricky, right? Because then they start getting into a compliance situation, which is, profiling. Well, I'm going to let Liz do it, but I'm not going to let Stuart do it, and so on and so forth. So that's a very tricky thing for lenders as well. And so one statistic that already came out is 80% of the people applying for forbearances right now are grade A borrowers. Great jobs, great income, great assets, low debt to income ratio. So the fear then starts to become, what about all these people that can't make their payments truly and need the forbearance? Imagine the wave of people that are going to all of a sudden have a get out of jail free pass card, so to speak, on their mortgages, but then have to pay them back later. To me, it's a scary thing. I just read this morning that one of the biggest servicers in the country, name's Mr. Cooper, they are taking on 8,000 to 22,000 forbearance inquiries a day right now, which is just crazy. And right now, 2.5% of their servicing portfolio, they've allowed to forbear their payments, which is, I think it came out to like 86,000 consumers so far they've given the forbearance to. So the reason I bring this up is because as a lender, so if you're VIP mortgage, okay, and all of us operate the same, so all of our competitors, it's all a very generalized thing. I'm just using this as an example. If we close on a particular high-risk loan, meaning a loan that we deem might be risky for someone to not be able to make their payments, what happens is that these lenders like us, we might have to buy those loans back. So if I close, I'm using Liz as my example. If I close Liz's loan and we sell that loan to Chase Bank, and Chase Bank decides to audit that loan and realizes that Liz has not made her first 2 payments, which we call early payment default, which is different than a forbearance, keep in mind. This is someone just literally just missing their payments without any communication. The agreements in place typically with mortgage lenders like us is we have to buy those loans back. So inherently, that makes these loans a lot more risky, which is what kind of plays into some of the product changes and why you're probably hearing lenders saying we're no longer doing this product or that product. It's because as lenders, our job is to protect the house, right? Which is our company. And if we see the chess game unfolding and we see that there's these potential for early payment defaults because people are going to lose their jobs, lenders are going to start pulling out of certain products. And you know, the CEO of one of the other biggest loan servicers in the country, a week or so ago, I was watching, and again, it's one person's opinion, but he said he thought the mortgage delinquencies this time around would be more than they were in 2008. That's a pretty bold statement in my opinion, but it just goes to show you that when people start talking like that, it creates uncertainty and kind of this fear in the air. And lenders do not like that. So what ends up happening is they start mitigating these products to try to ensure that they don't get in a situation where they're closing loans that they don't have a home for, meaning they can't sell them. So as an example, if VIP Mortgage closes $10 million in loans, if we have nowhere to sell those loans, that means we have to sit on those loans and service them ourselves. And that's not what we want to do, because then that ties up our warehouse line capacities, which ends up limiting how much in funding we can do. So to give you just a quick scoop on that, a mortgage company's warehouse line is like you and I's credit card. That's exactly what it is. It's a big line of credit, and let's call it a $100 million line of credit, that when I fund your $1 million loan, I've got 99 million left on that line of credit. But when I sell your $1 million loan to Chase Bank and they pay me back for it, I pay my credit card balance back down, and now I have 100 million left to use. So as I use up that line of credit and I have less and less availability and I can't sell those loans off of the line, we call it, it threatens my capacity to fund more loans, if that makes sense. So big lenders realize this, and they, again, make changes to their products in order to ward off a situation where they literally can't service clients, which is the worst thing that could happen. So that being said, because of that, that's one of the few reasons why we're seeing some major product changes. And this is the part where I would tell you that, is the most important to listen to. Oh yeah, let me hit this real quick. Sorry. Yeah, we can do the products. Excuse me, guys. So the State of the Union slide right here, as I talk, I have to stop myself because it just seems so doom and gloom, right? Like I'm just sitting here like glass is half full, the world's ending, lenders are pulling out of products, warehouse lines don't have capacity, everybody's going out of business. That is not what's happening. There's just changes being made to ensure the viability moving forward once we get through this. Part of the good news is interest rates are still historically low. So this chart that's on here is Freddie Mac's weekly average survey they do, and it's an average number. So to be very clear about this. So on here it says a 30-year fixed, which is the middle number, is 3.33%. That's absolutely an obtainable rate today, but keep in mind that it's a national average, and it typically comes with a version of discount points or cost to obtain that rate. So I have to be careful when we show you rates, because I don't want you to see that and go, oh, I can get 3.3 without any cost. That's not necessarily the case. But I can tell you, for what it's worth, just as of this morning, we were pricing out just a standard conventional loan, 20% down. And the rate was right around 3.2, 3.3% with a small fraction of discount point cost, which is pretty good. Or 3.5, 3.6 with no points at all. So rates are still great. Refinance, what that's done though, is that's also triggered a huge amount of refinance volume. So in the mortgage industry right now, most companies are actually having record months. VIP Mortgage had our biggest volume month in March that we've had since we started the company 12 years ago, which is just crazy. And it's because we've had a ton of refi volume come in. And the reason I'm telling you guys this, not that you care about refinance volume necessarily, but is because the other thing that happens that's interesting in these markets is when banks get inundated with files, they lose their capacity. So they've got like a gas tank, right? And as their gas tank fills up with loans and they no longer can do any more loans, they purposely change their rates to ward off volume. So we saw about a 2-week period where, and you guys may have experienced this, where you thought, oh my gosh, rates got to be so low. And you called your lender or you looked into it and rates weren't as low as you thought they were. And that's the reason for that, is because these big servicers like Chase and Wells Fargo, they turn their rates up, they change their margins. So that way, when a company like VIP goes and prices a loan and sees at Wells Fargo it's X rate today, the rate's so high that it's not even attractive. So what they're doing is they're essentially, instead of just closing their doors and saying, hey, we'll be back in 3 days, they're keeping the doors open, but it's so unattractive that nobody's locking loans with them. So we've seen a lot of that going on right now, of them managing capacities and volumes by trying to mitigate that with pricing. The good news is it's starting to get better. We're starting to see that the proverbial golf ball's going through the hose, and they're getting a little bit of capacity back now, and we're finally seeing rate sheets coming back down to some extent. So just good info for you guys to understand. And then if you go to the next slide, Liz, if you don't mind. Okay, back to the product changes. So, right, we have forbearance, we have all these weird things happening. Lenders are scared, they're making changes. And one of the other things that the other two functions of why products are getting yanked out of the market is because there's no liquidity in secondary markets for certain high-risk products, okay? So what liquidity means in layman's terms is, if I'm Chase Bank and I've got a $20 million pool of loans that I've pulled up and I'm gonna securitize and go sell on the secondary market to an investor, because that's what they do, there's no investor to buy it for certain products. So non-QM is listed on here, which are portfolio niche type programs like bank statement programs you guys have maybe heard of. That's one popular one. Well, all of a sudden Chase has all these bank statement programs. They go out to the market to sell them and there's nobody in line anymore. That's what they mean when they say no liquidity. There's no one's going to buy these loans. So if no one's going to buy them, and our business is buying and selling loans, meaning not VIP, but the overall business of how mortgages function, then they're going to stop doing the products because there's no home for them, right? I'm not, give you an analogy. If I'm a factory that makes cars, I'm not going to keep making cars if nobody wants to buy them, right? I'm just going to stop production until people are ready to buy them again. That's exactly what's going on. So that's the other reason on why products are changing. So on our list here, the non-QM, which I hit, are, and QM's qualified mortgage, guys. So years ago, the government came out and said, there's a QM mortgage, which fits in this nice little pretty box, a qualified mortgage that meets certain rules and it gets underwritten a certain way. And lenders have to have a certain amount of capital requirements for those loans, meaning money in the bank. Then there's non-QM, which is outside of the box portfolio products. Like, I don't need your tax returns. I just go off your bank statements. Asset depletion. Products like 2 days out of foreclosure, right? So we all know with a conventional loan, you have to have 7 years from a foreclosure. Well, for years, we've had products that have given us a solution to that, which literally you can be 2 days out of a foreclosure, a month out of a foreclosure, and we can do these niche portfolio loans, which are non-QM loans. Those are gone, okay? I hate saying definitive words like gone because yes, maybe there's a lender or two out there that are still trying to do these loans. I actually know a couple names of people, places that are trying to do them. But for the most part, guys, those products are out of the market completely right now. Down payment assistance, just quickly touch on this. Similar concept, high risk loans, right? These are typically consumers that don't have a lot of money in the bank, high debt to income ratios, lower FICO scores predominantly, not all of them. And so they're inherently more risky for those first payment defaults. So what happened was, you guys probably heard the chatter that people stopped doing down payment assistance. But the interesting thing is the aggregator, the one place that we all send these DPAs to, we all send them to the same buyer, if you will. They haven't said they won't buy them. So this is causing confusion because people are going, well, hold on a minute, Stuart. I talked to one lender over here. He said they're not doing DPAs anymore, and the DPAs are gone because the way that lender decided to promote that message, made it sound like the programs themselves went away, but they didn't. And then you have another letter that says, well, that's not really true. They didn't really go away, but we're just not doing them. And then as a realtor, you go, I don't even understand what's going on here. Like the game of telephone, right? I say one thing, it gets 8 people down the line. By the time it gets back to me, it's like I said orange, an apple showed up, right? It's not even the same thing. So that's where we want to do calls like this and clarify these things. So DPAs did not go away. They still exist. You can still fund them. But because of their risk, most lenders have stopped doing them until things normalize, because they don't want to get stuck holding these loans if all of a sudden the DPA aggregator goes, wait a minute, we're not buying these anymore. Because the scary thing about our industry is I can be doing Liz's purchase transaction and I can get to the finish line, meaning I am ready to fund her loan. She signed her loan documents. It's a done deal. And they could come out with an announcement like that that says we're no longer doing these, and they don't have to grandfather it. So I'm just, and let's say I funded her loan. I'm stuck with that loan now. I can't do anything with it. I can't sell it because now all of a sudden they're not buying them. So it's not fair, but that's the way it is. So that's why lenders go, brakes on, hold on. I'm going to chill out for a second until I feel good that I can get these loans sold. So VIP, were our stance on DPAs right now. And I'm very transparent, guys. I mean, I'm never going to tell you it's not the way it is. We went from a stance of halt, we're not doing any for 30 days. And now we've kind of backed off and said, okay, we're going to do them on a case by case. They have to make sense, and the file's it just has to make sense. So we're reviewing them case by case. So we're technically still doing them. But you know, it's just a little bit, there's more of a magnifying glass on those files, if you will. In terms of FHA, really the reason that's on this list is low FICO scores, back to risk, right? Because so you could used to be able to do an FHA loan down to a 580 FICO score. Technically they still exist. Technically there's lenders doing them. Most lenders are not. So most lenders have drawn the line in the sand at 640 and above. So even at a 620 FICO score, 630 FICO score, most lenders aren't doing those FHA loans right now. So that's something to keep in mind. And what's interesting is if I go into my system and price a 625 FHA, even though I know I can do the loan, the pricing is so atrocious on it, you almost don't even want to quote it. And the reason goes back to what I was saying earlier, these big servicers purposely don't want these loans right now. So instead of just saying, hey, we're not doing them, they just crank their price up so nobody wants them. And then the last one on the product changes is jumbo. And there's a lot of confusion with this. You've probably heard of lenders saying we're no longer doing jumbo loans. I've had people contact me and say, oh my gosh, I heard there's no jumbo loans. What's going on? Not true, game of telephone. There have been major changes to some jumbo products, but jumbo loans still exist and are still going pretty strong. The main changes to jumbo loans are the high loan to values, so the low down payment. So like the 10% down jumbo, which is a really popular product, most of the big lenders that we would sell those kind of loans to have pulled out of those markets and they're not doing them anymore. So essentially they don't exist. And what I would tell you on that note, if you're being proactive and being, what I think you should be doing, if you guys think you have a jumbo transaction going or any of the ones that I've mentioned so far, go back and check your pipeline and make sure that even if you're on the listing side, if you're representing the seller, go back to that buyer's agent, just say, hey, I heard some things are changing. I know this is a, FHA, or I know this is a 10% down jumbo. Do I need to be worried? Can you check with your lender? Like, absolutely do that. And for the low down payment jumbo stuff, the easiest way to do that is pull your contracts, look at the loan size on the contract, look at the purchase price, do the quick math. And if that looks like less than 20% down on a jumbo loan, which to be clear, jumbo loans are anything over 510,400. So 511,000 or higher is a jumbo loan. I would be reaching out to all parties in that transaction to get some warm and fuzzies, if you will, that thing's gonna happen. Because there are solutions. If you guys have been doing this as long as I have, you might remember the old 80-10-10 days when we did piggyback mortgages. So you had a first mortgage and a second mortgage. That's how we're saving these 10% down jumbos right now, is we're structuring them that way. So There are solutions. You just make sure you're working with someone who understands the strategy and how to kind of play this chess game. So hopefully that's helpful. But the other thing on jumbo loans too that we've seen is they're no longer allowing cash out on a refinance. You no longer can do an investment property purchase on a jumbo, which we don't see very many of those, but just want you guys to be aware of it. And one thing that's good for you guys to know is these are all wholesale changes, meaning if you're Chase Bank, you have a wholesale arm and a retail arm. The wholesale arm is when you're dealing with guys like VIP Mortgage. So when they come out and say, we're no longer doing this product, it doesn't necessarily mean on the retail side they're not doing it. But here's a perfect example, and this was a big, big announcement. Last week, Wells Fargo sent a memo to all of us, meaning all of my competitors, the whole mortgage industry on the wholesale side, saying we're no longer doing jumbo loans, period. We're done. Now, again, that's for now, right? I'm sure once this all clears up, they're going to go back to normal. But that's a bold statement coming from Wells Fargo. It's one of the biggest loan servicers in the country. And that was wholesale. So now you can see where the rumors start, right? I heard jumbo loans, you can't do them anymore. Now, if you were ABC Mortgage Company and the only place you sold jumbo loans to was Wells Fargo, because remember, guys, just because VIP may have 30 different servicers and banks I can sell loans to and get products from, but you don't just get those relationships. You don't just, fill out an application and, they turn you on. I mean, you have to go through a process to set all these people up and they have to approve you and this whole deal. So if you had a smaller lender that only could sell to Wells Fargo, let's say, and all of a sudden Wells Fargo pulled out, well, then guess what? That lender can't do jumbo loans. And when they told their realtor there's no more jumbo loans, well, technically in their world, they're right. The interesting thing about this particular topic is Wells Fargo on the retail side, which means walking into a Wells Fargo branch and talking to the, teller guy about a mortgage. They came out and said, this just happened on Sunday, I saw this. They will only do refinances for jumbo loans for their current clients at Wells Fargo if you've got $250,000 cash in the bank with them. So that shows you how much they're trying to not do these products, right? They're purposely making these rules to sort of like push people away and to make them less risky. So I'm just checking something to make sure I didn't miss some of the key things. So those are the main things with the product changes, guys. And really, it's not all that bad. I think it's a fresh cleansing happening in my industry. And there's a lot, we have lost very few deals because of all this. Most deals we've been able to find a plan B for, and you'll be surprised how motivated somebody is to go to a plan B if they don't have plan A anymore. And a perfect example of that is, one of ours, we had a client who was in the beginning, we had said, if you can get gift funds, this would be a great way to go. And they said, oh, no, there's no way my family's gifting me money. Okay, no problem. So we set it up a certain way. Well, now that program we can't do anymore. So now the only way to do this is to get the gift funds, and now miraculously they're able to get the gift funds and the deal's going to close, right? So that's not going to be every case. I realize that, but you might be surprised at how quickly we're finding solutions and plan Bs that are good plans too, that are helping save these deals. So I personally haven't seen a whole lot of deals fall to the wayside. I've only seen one client kind of back out just out of nervousness because they weren't sure what was going to happen with their job. So it's not a sweeping terrible thing. I wouldn't be losing sleep over it. And the next topic that kind of segues into is the verifications. Excuse me, meaning the loan process, the assembly line of getting a loan done. We have to verify somebody's employment. And the way that process has worked for years and years is I'm doing Liz's loan, and in the beginning stages, I send her employer, VIP Mortgage, a form, and they fill out her HR fills it out and says, yes, she works here, she makes this much money, and all that's true. Good to go. Then within a few days of closing, we're required to do what's called a verbal verification of employment, where we literally have someone who just calls VIP and says, hey, does Liz still work there? She does? Perfect. Hangs up. That's literally the phone call. And then we check a box, we put a piece of paper in the file, says we made the call, and we're done. Well, what's happened with all this is it's harder to get a hold of those HR departments because they're inundated, they're working from home, they have less resources, et cetera, et cetera. And so Fannie Mae, Freddie Mac, all these big aggregators have come out with reduced rules saying, okay, we get it. And I'm just going to say, I'm actually been very happily, I kind of been impressed with how fast Fannie and Freddie and these big aggregators have made these changes to help us. It's been, you know, nice to see how nimble they're moving. And one of these was, okay, we get, you might not be able to get someone on the phone. So just get an email. If you can get someone to email you back, or get an updated pay stub or a bank statement showing their payroll deposit coming in, something just showing they still work there. And so that's helped us. But the other reason that this piece is important to bring up is now as lenders, and again, I'm speaking for the lending community, so to speak, not for us specifically. It's our job and our fiduciary duty to make sure we don't set people up for failure, and we don't put people in positions they shouldn't be in, and we don't waste our referral partners' time by telling you to go, you know, get someone in the car that qualifies now, but they probably have a job they're not going to have in 30 days, and then you've wasted all your time. Right? We have to. This is a very fine dance we have to do right now, and an example of this is, you know, we had we had to start going through our pipelines on the down payment assistance programs when this all first started unraveling. And we had a client that we looked at their profile right before closing, and it didn't look good. I mean, literally, they were squeaking by to buy this house, no money in the bank, and they both worked at a massage place so we had our loan officer call them and just kind of talk it out. Hey, what's going on with your job? You can't really do it from home. Are you open? Are you still going to get a paycheck? And the client said, no, we're good. Our owner said he's getting an SBA loan. He's applying for it, and he's going to keep us on payroll for 3 months and get us through this, and it's all good, et cetera, et cetera. And so the loan officer turned around and told, you know, VIP, hey, I think we're good. Good call. Oh, and the client said, you can call my owner, and gave us the phone number. So we called the owner, and the owner told a different story. And he said, well, that was true, but I'm having trouble getting the SBA loan. It's not as easy as I thought it was, which we're hearing that story everywhere, by the way. And I probably going to have to close my doors, and I'm probably not going to be able to pay these people for a while, and I don't know what's going to happen. So we had to make a judgment call on that deal. And I'm just going to be upfront with you. We didn't let it fund because these people were not going to have a job and be able to even make this payment. And that was going to turn into an early payment default. We were going to have to buy the loan back, assuming we could even get it sold. So that's another reason some lenders are just cutting the cord. They're just saying, nope, we're not even taking them anymore. But we're trying to do it in a more responsible, well, I shouldn't say more responsible. That's not fair to other people. I just mean, we're just doing it in our way and looking at these files case by case. But the point of me telling you guys this is, we all have to be more proactive now when we're having these conversations, and we have to kind of understand what these people do for a living, because if we qualified somebody that does X job, but that's a job we know they can't do from home, I don't want you still in the car showing them a house if all of a sudden you find them a contract, right? So when we pre-qualified 3 months ago, when COVID didn't exist in our world, and now it's like, oh, I don't have my job anymore. I mean, you guys will be shocked. You will be shocked at how consumers just don't align these dots sometimes. Meaning we had somebody yesterday that, you know, literally quit their job because it wasn't happening and made a drastic move days before we're supposed to fund the loan. And literally, as we talked to them about it, they weren't even grasping why it was a problem. So don't underestimate the, you know, the ability to not acknowledge like some of this with your clients. And it's just important to be in front of it. So I don't know, that was just my point there. So we're being careful having those conversations, but we're not scaring people off. We're just making sure they understand that, hey, if something's going to change with your job in the future, you're pre-qualified now, just keep us posted. Stay in high communication. We're here to give you solutions and strategies. And, you know, we just don't want anybody being in a bad spot. So the other thing on verifications is transcripts. Just quickly, tax transcripts basically are something we use. Like if you're self-employed and you filed a tax return, we have to prove that tax return that you said you filed is what you actually filed. So we send a request to the IRS for what's called your transcripts. The IRS shut the whole thing down. They said, we can't even process transcripts right now. Stop giving us requests. So as a company, we made an executive decision to still allow closings without tax transcripts and getting them in the files later after closing on most files. Now, there are some files that we still are going to require transcripts on, depending on the complexity of if they're, you know, filing amendments or they file their tax returns late or things like that. So it's not all super black and white, but the good news is that we're not letting these other third parties who can't perform stop us from performing if we feel like we're making a common sense move. So that's really it on verifications. And the last thing I was going to hit in terms of appraisals is, this is a big topic, but the good news is I don't think it's a big deal. So a lot of people are asking, well, Stuart, what's going on with appraisals? And I don't want to, what if my client doesn't want someone coming in their house, and how are we going to do this? We've talked to all of our big appraisers on our appraisal panels and our appraisal management companies, and they are seeing very, very little requests for anything more than a full appraisal. And to give that some clarity, at one point, the aggregators, Fannie Freddie, came down and said, okay, we get it. People may not want people in their houses. Appraisers might not want to go in somebody's house. So we need to allow for reduced appraisal rules, which means they allow for a drive-by appraisal, what they call an exterior only. And we do accept those. So we're allowing those as long as it makes sense on the deal. I mean, if it's a super custom, unique house, you guys can appreciate in some cases a drive-by isn't going to do you justice for the value. But if it all makes sense and the deal works with it, great, we'll allow it. So that's the good news. You do have an option for reduced appraisals if you have a client that voices a concern. But the good news to me is very few people are raising their hand on that. These appraisers are saying they're not really getting orders like that from other lenders, which tells me other lenders is the same as us. They're not seeing it. Of all the people that we come into communication with from a client standpoint, I can only think of one example where a lady raised her hand on a refinance and was like, I really don't want someone in my house. And so we did an exterior only, and it worked and done. So it's not a big issue, and I don't think it's going to be. But of course, you have questions on that, let me know. On the virtual related changes, just the last quick topic, I think all we mean on that is the beauty of what we do for a living on the mortgage side is we're business as usual. 97% of my company is working from home right now. We've got 430 employees. So, and everything is going just like it normally does in the factory. Loans are processed, underwritten, docs are drawn, loans are being funded. I mean, our operation is just as smooth as it's always been. The only reason we would be at all delayed on something is just because of a third party, right? If an appraiser took longer to get back to us, if a title company was inundated. So we're really blessed on our end that it's not affecting our ability to do our job. I mean, I'm at my house right now. And so we're doing lots of these Zoom meetings, and we are a purchase-based operation, meaning even though we're inundated with refinances right now, which is a great thing. We're taking care of a lot of people, and we're saving them a lot of money as well as all of our, peers out there. But we will always be forward-facing and focused on our purchase business and our referral partners like you guys, because that's really what we focus on, right? So I'm telling you that because I'm leading into the fact that we are not taking longer to close purchase transactions. So, because I'm getting that question a lot. Hey, I'm writing a contract. What's going on? And that's a fair question. If I were a realtor, I'd be asking the same thing. Do I need 45 days? No, you don't. We can still close quickly. We can still, we did one a few months ago before COVID in 8 days, which is legally the fastest you can do it per the government. We just cranked one out in 2.5 weeks. So they're still doable quick, guys, especially if you have a multiple offer situation or you need like that extra kind of muscle, when you're competing. If you're working with us, that's something that we can offer. So, but I just want you to know that. So it's positive. We can still get it done, and it's all good. So I think that's all I got.
Well, that was great, Stuart. Thank you for all of the updates. And now we'll open it up to agents for questions on anything that they may want you to touch on. I know we had one in the chat a little bit earlier that I may have you address, and it was related to kind of the financial markets and investment accounts. And I think there's a lot of misinformation regarding that. When people said that the Fed dropped rates to 0, there was a lot of confusion between rates on the financial markets and investment account side versus on the mortgage side. So maybe if you could give a quick little recap on that for agents to understand.
And I want to make sure I'm understanding the question, Jim. Is it more along the lines of if you're and I'm sorry if it cut out for a sec there, Liz, so I want to make sure I didn't miss it. Is this along the lines of like if closing funds are coming from investment accounts?
Jim, pop in if you want to clarify, but I thought he was more meaning how that was when we were talking about the State of the Union and the financial markets. So my understanding was that he was asking about how it was affecting rates on that side of the spectrum, and how if they're
Yeah,
correlated.
actually, I just I just got in. I had to walk out of my room for just a few seconds, and I just walked in, and all of a sudden, I heard my name. So, yeah, actually, I think we're talking about maybe, investment accounts, like you have money that's set aside into, whether it's a 401k, or if you have for instance, the stock markets, although the way things are in stocks, right now, I mean, everything has dropped for a while, although we got a third of that back before the crash. But things of that nature where we throw in some financials or utilize the financials from the stock market, or from from investment accounts, wherever you're investing in stock or whatever, that you use that for your
Qualification.
other source of other source of income. I don't know. I'm just,
that's right. So that's a great question. So, and I do have an answer for that. Some of the guidelines when you have money sitting in an invested account, so it's in stocks or something that is fluctuates and is volatile. When you use those accounts for, let's say, reserves. So on jumbo loans, all these programs have a reserve requirement, Jim. So meaning they may want 6 months of payments in the bank for reserve. Well, when you use those invested accounts, every lender's different, but some lenders let you use 100% of that account balance. Let's say there's 100 grand in your TD Ameritrade account. I can use that full 100 grand for your 6 months reserves. Other lenders will give it what we call a 30% haircut and only let us use 70% of that balance for the reserves because they realize markets fluctuate. In light of what's happened, we've seen some of these lenders who allowed 100% of the balance go to the haircut model and say, wait a minute, yep, we're not gonna let you use this full account for the reserve piece. So that's one answer to the question. The second part of it would be, it's absolutely something on our end in which we're trying to be proactive. And if we've pre-qualified people who are using money in those types of accounts, kind of re-going through those and making sure that we're having those proactive conversations. And, are you still able to do this? Because whether it's right or wrong, if I had to guess, I would probably say that 60% of consumers don't really watch that on a daily basis. Even in something like this right now, it's probably one of the first times they're going in and looking at those account balances. So because of that, it's important that we stay in front of it, because as shocking as that may sound to everybody, you'd be surprised. Someone will go get in a car and go look for a house right now, not realizing that their balance is 30% less than it was. So, we just have to have those conversations. And I'm not sure if that answers the question, Jim, but.
No, it's good, because, I mean, obviously, the way things have happened when the virus came out, a number of buyers had utilized, I mean, not to make payments, but to utilize those accounts to make a down payment. And then they became hesitant once they realized, they saw where the market's going. It's fallen 30%, and all that's gone. I mean, it's affected, it's affected a number of people along the way. But I mean, but still, I mean, the real estate market's still moving pretty fast. I mean, from from $300,000 to $500,000 up in North Phoenix. I mean, everybody's throwing offers left and right, and they're throwing in above list price offers. So, it's kind of a funny, it's a funny market we're dealing with right now. But from an investments market standpoint, I didn't know if, in terms of making payments, if that could be utilized or not as a possible additional income or whatever. I'm sorry, I'm kind of rambling a little bit.
No, you're good. It can be. I mean, there are certain people who qualify with dividend and interest income that comes off those types of accounts. And the lending rule's always been on that. I'll do easy math. Let's say they get $1,000 a month in dividend income we're using. We have to make sure that they've got enough of a balance to, we call, that's like a rate of withdrawal calculation. So they have a 3-year balance of that. So $1,000 a month times 36 months, which is 3 years, right? that's
Yeah, 36,000.
that number, they have that sitting in that account, if that makes sense. So
Okay.
could be situations where you qualify people with that kind of an income that because of the hit, they don't have the balance anymore to show that they have a 3-year continuance of that income. So
That makes sense.
for sure.
Yeah, but and obviously it depends what, you know, how much they have invested, you know, in it, you know, in the market, but you know, it varies from, you know, from investor to investor. Thanks.
Yeah, great question, Jim. Thank you. Awesome. Well, does anyone else have any other questions that they want Stuart to address? If you do, pop them into chat or turn your video on so that we can see and hear you. But he's happy to address anyone's questions. But we really hope that you guys found this valuable today. We wanted to make sure that you have the kind of accurate and up-to-date information to present to your clients so that you can still get deals closed on time. We're hopeful that you have a great lending partner that can assist you in answering your questions. If you don't, we're always here as a resource for you guys. And as Stuart said, one thing that we really pride ourselves on is being very proactive with finding solutions for all of our buyers, because ultimately, as he said, we are a purchase-based team. We've always been a purchase-based team, and our realtor partners are our primary clients. So we want to make sure we're doing everything that we can to help you guys get deals done during this time. And we have some other great resources that I'll email out to you guys that you can offer value to your clients that on some of the things that there is some misinformation on. With regards to forbearance, the CFPB has put out some really awesome resources directed at consumers at breaking down kind of what their options are and really, as Stuart said, some of the misinformation that's out there. It's not just you're free to not make payments for a while. In addition, we have some other information on the different options for business owners. If you have clients that may be in that situation where they're struggling to figure out how they're going to maybe make payroll for their employees this month, things like that. There's some really great resources out there that you can offer to clients. So we will send those following this. And then another thing we wanted to just urge you guys is be conscious, as professionals in our industry, we have really an obligation to be proactively communicating in a really compassionate and warm way with our clients during this time. The market is still very strong here locally, thankfully. We had such a pent-up buyer demand that we are in a really great situation here with our local housing market. So we still have to be able to communicate that to our clients that we are able to get their deals done. It is a great time to buy a house. If they're a seller, it is still a great time to sell your house because values really have not come down at all due to the coronavirus. So, here's some great tips on how to make sure that you're communicating really proactively and positively during this time. And I think that was kind of it that we have for you guys. So feel free to pop in if you have any other questions. If not, there's our contact information at the bottom of the screen there. If you want to reach out to us, we're always here as a resource for you.
Thank you guys for coming. We appreciate it. And feel free to email us if you have anything or think of anything later. And even if you hear something and you want to know if it's true or not, just bounce it off us and we're happy to help.
Awesome. Well, we'll stay on for a couple more minutes, but thank you guys so much for joining us today. We hope that it was helpful, and everybody stay well and productive out there.
Thanks, Liz. Thanks, Stuart.
Oh, thanks, Aaron. How are you?
Hey, buddy. You look like you're living the dream right there.
I like the shades.
Well, you got to do something to get through all this.
I hear ya. Nice.
Thanks, you guys. That was a really good video. Solid.
Oh, thanks, Ed. Appreciate it.
What's up, Ed?
Another thing too, there's only a few of everyone's kind of popping off, but I have a really great class geared for agents. It's called 15 Productive Business Activities to Complete During Quarantine. So I'll send that out to you guys. It's really helpful to find some ideas of ways you can really grow and build your business during this time. So I'll send that out. Thank you all.
Have a great day.
You guys.
You too.
Mm-hmm.